All right, welcome everyone. I'm Andrew Logan with Ceres. I'm your MC for today's live streamed Ceres 2020 digital program. I'm also the Senior Director of the Oil and Gas Program at Ceres. And those of you who don't know us, Ceres is a sustainability nonprofit. We work with investors and companies around the world on some of the most critical sustainability challenges that we face, from the climate and the water crisis, the protection of basic human rights throughout the global workforce. I do want to start today just by saying that we remain mindful of everyone who continues to be affected directly or indirectly by the COVID crisis. And, we continue to be especially grateful to those on the front lines working so hard to ensure that we all stay healthy and safe. And in fact, if you hear small children banging on the door in the background, it's because my wife is one of those workers taking care of COVID patients at a hospital here in Massachusetts. So I apologize for that in advance. I also want to thank each of you, all the participants, for taking part in today's program. I also want to highlight and say how much we appreciate the generous commitment and support of our speakers and our sponsors who have stood by us on this digital journey to reimagine the Ceres 2020 conference program. We clearly wouldn't be here without your support and energy. And we organized this panel months ago in a very different world when oil was in the $60 a barrel range, and only a single company among the oil majors, Shell, had moved in any real way to address the full scope of its carbon footprint. It's the scope 3 emissions associated with its products. But we thought at the time that this would be an interesting moment to examine where the industry was at and the ways in which companies could adapt to a low carbon future where demand for their products would finally begin to peak after a century or more of nearly nonstop growth. And since then, we've seen the price of oil briefly go negative. We've seen the industry's valuation shrink to such a degree that it is now the second smallest component of the S&P, down something like 80% from a decade ago. But at the same time, despite these profound challenges, or perhaps because of them, we've seen a string of companies in the last couple of months, including BP, Repsol, Eni, Total, commit to addressing their scope 3 emissions and bringing them in line with the ambitions of the Paris Climate Agreement. We've seen in the last couple of weeks shareholder proposals on scope 3 targets get majority support at Woodside Petroleum in Australia and at Ovintiv in Canada, which is what in Canada is now called. And we've heard the CEOs of Shell and BP, on earnings calls, no less, raise the prospect that the COVID crisis could actually accelerate the day when demand for oil peaks and begins its decline, which interestingly enough puts those CEOs on the same side of the issue as today's moderator, Rob Schuwerk with Carbon Tracker. So today's discussion truly cannot be more timely. So before we get to that discussion, just a couple of housekeeping notes. This session is being recorded, so you'll all have a chance afterwards to access the link of that and re-listen if there are parts that you missed or wanted to take more detailed notes on. So look for that in your email this afternoon. If you have any questions for the panel, feel free to enter them at any time in the question box that should be on your control panel. We'll largely save those for the end, unless they're just clarifying questions about issues that are being raised along the way. Then finally, as with any webinar, there is potential that due to bandwidth issues, we could experience some challenges. If that ends up happening, if we end up freezing in place, we'll just pause for 30 seconds to allow things to catch up, and then we'll continue as usual. So thanks in advance for your patience if that ends up happening, though we certainly hope it will not. So now it is my pleasure to introduce our moderator, Rob Schuwerk, who is the executive director of the North American operations at Carbon Tracker, along with our panelists, Jeremy Baines, who's the president of Neste US, Dialynas, who's the lead U.S. oil analyst at Bloomberg New Energy Finance, and Carolina San Martin, who's managing director and the director of ESG research for Wellington Management. And so with that, I'm going to pass it off to Rob.
Andrew, thank you so much, and thank you to Ceres for putting together this really interesting panel, which I agree has only become more timely since we all agreed to be on it. So wonderful to be with you and with everybody else today. And so on this panel today, we're really looking at a single question, which is unique and existential challenges that the oil and gas sector faces, and frankly, how it should respond to these challenges. And today, I'll refer broadly to sort of two types of responses that companies can make, and obviously there's plenty of nuance in between, but one I'll call a diversification strategy, and that's a strategy by which an oil and gas company would seek to enter other markets that were in other lines of business that were not as carbon intensive as what they have today. And the second is what I would call a harvest strategy or a managed decline, which would be to focus still on its core business, but but focus only on the sort of highest margin assets and development of those assets in that business, with the expectation that there would be a declining market, for that core business today. And think about what those kind of strategies would mean. And today we have the benefit, of course, of speaking with panelists, both working in I would say, a unique area of diesel fuel production with Neste, and also an investor who has a sort of integrated approach to thinking about environmental and other factors in their analysis of the investments, and then a lead reporter who is analyzing this sector from the outside and give that perspective as well. So thank you, everyone, for joining. I'll just make a few remarks today about the sector, and then get into some questions for you, have a dialogue, and open up to Q&A at the end. As Andrew noted, I mean, I think that, COVID-19 has changed quite a bit for the sector. We have Shell's CEO saying that the world has fundamentally changed. We have just several days ago, BP CEO indicating that it's possible that peak oil happened in 2019, not that he believes it necessarily has, but that it can't be dismissed. This is something that our own analysts, like Carbon Tracker's Kingsmill Bond, has pointed out before, which is that it is possible that by the time demand for oil returns to what it was in 2019, substitutes will have increasingly taken all the growth market share. And when that happens, then you're not going to have a year where you have more demand than you did in the year prior, which is really sort of the story behind why there might be a big today. But beyond the sort of mathematics of returning to the demand we had in 2019, there's a behavioral element as well, as something, frankly, as traumatic as a pandemic can force people to think their business and things that they consider as background assumptions in their business. This may open up opportunities for companies like Neste, for example, as they look for clients in aviation fuels and other things as the future goes forward. So how that is going to change people's thinking today, I think, is also a valuable thing to talk about. And finally, you can see even in the economic stimulus that's the packages that are put together in response to the pandemic, that there's questions about whether they should be green, whether they should prop up legacy lines of assets and businesses, or whether they should be put into new lines of businesses and dealing with other global problems such as climate change, rather than waiting for that one to potentially catch us off guard as well. Governments are doing different things on that, but the fact is there is a lot of consideration of climate already in the pandemic response. The last thing I'd point out is that there is several days ago, Shell decided to cut its dividend. It cut it about 66%. And it's the first cut, I believe, that company has had of its dividend in the last 75 years. The idea that you need to maintain those dividends is a mainstay of sort of the investment thesis for the industry. And this is both a sign, I think, of this difficulty that the industry is facing, but also a sign of the fact that maybe people will begin to rethink this. And so I think that will get to sort of the investment proposition and some questions that we are going to raise today. But without any further comments, I'd like to sort of kick it off. And I want to start with you, Jeremy. So our focus today is basically on how companies, oil and gas companies, should be addressing a decarbonizing world. I'm very curious to get your perspective on this. So Neste focuses on renewable diesel and advanced biofuels, which are really substitutes for certain petroleum products. But before that, it was also a refiner, and I believe it had a small exploration and production business at some point in time as well, right? But those things are now long gone, and it's focused solely on this. Could you tell us a little bit about the transformation for the company? And then sort of answer the question of whether you think others in the industry could replicate what Neste is doing, or is it somewhat of a unique bird?
Yes, thank you, Rob. Thanks for lining that up, and thank you for inviting me to this panel discussion today. So yes, my name is Jeremy Baines. I'm the president of Neste US. I've had actually the pleasure of working for Neste for 18 years now. And maybe just to work off the ideas that you were presenting, at the end of last year, I was asked to think about black swan scenarios. And the COVID crisis that has now infected millions of people and devastated the livelihoods of billions of people, I can tell you was not one of them. And although scientists had warned us that a pandemic might at some day happen, I think we can honestly say that as a society, we didn't take this seriously. And I think in the same way that scientists have been telling us now for decades about climate change, I think we also need to admit that society has really been doing very little about it. Even if farmers in the Midwest are reporting extreme weather and coastal communities on the seaboards are being impacted by that, and here I'm in Texas, on the Gulf Coast we live with an increasing risk of catastrophic hurricanes, still not that much is happening. And Neste as a company is actually in the business of fighting climate change. And we've been in that business for over a decade now. If you want, Neste is a green swan. We are showing that it is possible to create sustainable, profitable business model grounded in renewable products. And now that cities around the world have experienced clean air and clean skies for the first time in many years, unfortunately, because of this COVID catastrophe, people are wondering, do we really want to go back to skies full of smog and pollution? So I think now is really kind of that time where we have a choice. How do we want to restart the economy? Do we want to do it in a more sustainable way? Do we want to have more sustainable jobs that are not boom and bust for the oil cycle? Do we want a more sustainable economy where there's an enormous potential to build up whole new industries? And actually, do we want to have a more sustainable environment? And we can act now to create a circular economy where we recycle already existing carbon molecules over and over again, or we can keep releasing new carbon into the atmosphere by burning diesel and jet fuel made from crude oil. And I think, Rob, you also touched on this. There are existing successful policy solutions out there which are encouraging the use of low carbon products. And we feel that they really need to have a bigger role in fighting climate change and have a bigger part of that action. And the oil industry, you've mentioned many companies there, is actually really well positioned to lead this transition to a clean, low carbon economy. I mean, starting with a shift to advanced biofuels, they have the expertise, they have the technology, they have the distribution assets to produce and distribute renewable diesel, sustainable aviation fuel, and even in such areas as renewable polymers and plastics. So, and the only change that they would need to do is to move from fossil fuels as a feedstock to renewables. And it's not only the oil industry, but I think it's society overall. There are a lot of forward-thinking companies and cities that are also looking at making this change.
Great. So let me ask a little bit, dig a little bit deeper on that. So I know that there is the feedstocks, as I understand, that Neste uses are principally waste oils and other things. Now there will be emissions coming out at the end when someone burns those fuels, but at the same time you have the great benefit of being able, as I understand it, to be able to go into aviation fuel today. You don't have to go into aviation. You don't have to invent a new airplane, right? That relies on solar and other things. So that's one a big benefit of it. But taking a longer term perspective, so we've heard net zero ambition and other targets. Is it something that a large company could come in and completely transform their business to, or is it something that they can maybe do along the way? So is this a bridge, or is this an end solution?
I don't. So that's a big question. If we look at Neste as a company, Neste has been transitioning, but we have not transitioned yet. You're right. Well, Neste used to have exploration. We no longer have that, but we still have traditional oil refining. Yeah, the most important part of our company has transitioned to renewables, and that's why we dropped oil out of our company name a couple of years ago. We used to be called Neste Oil, now we Neste. So it is possible to transition, and I think one of the key things and one of the key differentiators about what these advanced renewable fuels do is that they work today. They work today in today's infrastructure, in today's engine, with today's technology. There's no additional investment needed. There's a lot of talk about electrification. And yes, electrification will work in the short term in passenger vehicles. I drive a compliance car, because it just makes so much sense. But there are just no electric cables long enough to power a plane. It's just not on the horizon. So for decades to come, we are going to have to use liquid fuels to power planes. We are going to need liquid fuels to power those hard to abate sectors, trucking, marine, the agricultural sectors. And that's where these advanced biofuels play such an important role, because you were talking about waste and residues. There's enormous scope to expand those. Neste, recently we acquired Mahoney Environmental to be able to collect more used cooking oils, but we're also exploring other technologies. We're looking at algae. We are looking at forestry waste. We're looking at winter cover crops. We're even looking at using renewable electricity to convert CO2 back into liquid renewable fuels. And these are technologies that, again, the oil and gas industry, they are familiar with a lot of these processes. They have the infrastructure in place, so they can make this transition if you want. And we're seeing it happening. We're seeing it with BP, we're seeing it with Shell, we're seeing it with a lot of the oil majors, even here in Texas.
Mm-hmm. That's great. Let me ask you one other thing. This is something that, a Neste company position. I'm just going to read a quote, and you tell me what you think this means for the oil and gas sector. This is a Neste quote where they said, operational management and board members must have the courage to leave businesses that might be profitable right now, but whose sustainability will be questioned the day after tomorrow. What in practical terms does that mean for a management team in terms of risk weighting their business lines today?
It means that you have to be committed to sustainability. It has to be at the core of everything that you do. Neste was last year recognized as the third most sustainable company in the world. That doesn't come easily. It comes in every single decision that we make. So yes, we look at it all the time. How can we transition to 100% waste and residue? So we already have the technical capability now at our renewable refineries to do that. But now, how do we get sufficient waste and residue supply? And I think this is a really interesting game. No company wants to produce waste or residue. Everyone's trying to reduce that. So on the one hand, companies are trying to reduce the amount of waste, and we are trying to collect more of it. So there's this race to find dirtier and dirtier wastes, which are harder and harder to process, but that have no other application today. Yeah, and if it has no application, that's even better for recycling those carbon molecules that are already in the atmosphere. Because Rob, you were saying that, well, actually, it still emits carbon. That's true. But the feedstock from which we make it has taken the carbon out of the atmosphere. So it becomes a circular solution, if you want. And we're very passionate about that circular economy, that circular activity, because you can keep reusing those carbon molecules. You can reuse them into plastics, just in the same way that we are looking into reusing plastics again and again and again. And then imagine a situation where you are taking the carbon from the atmosphere, putting those into plastics, and then reusing those plastics again. So it is possible to get to that.
Great. Thank you very much, Jeremy. Let me turn to Carolina for a second. So, Carolina, I know at Wellington there's a lot of intellectual cross-pollination between the ESG teams and the equity analysts. I've seen that in practice. You head up ESG research. And I know that you have been working on both dimensions, let's say, of climate-related risk. So physical risk, including the intensified hurricanes that Jeremy was mentioning, and I'm from Houston actually, so I know that in an intimate way, but also the transition risk. Could you tell us a bit more about your Wellington's frameworks for those two things?
Sure. Thanks, Rob. So at Wellington, we really view ESG research as an investment research discipline. And we are using the insights from our work to drive better decisions for our clients. And as you note, we work closely with our equity and credit analysts to do that, and to really focus on those issues within ESG that we think will matter to those outcomes for our clients. So climate change, and we think specifically physical risk within climate change, is going to increasingly matter to markets. And as investors, we generally don't have a crystal ball telling us what the future is going to look like. But with climate change, we have an exception. We have great information from the scientific community that is telling us at a high level of confidence that the future is going to be very different from the past. So as fiduciaries for our clients, why wouldn't we use that information to benefit our clients and to help our portfolio companies prepare for that future? So that's why I've been dedicating more time to physical risk along with transition. In 2018, we embarked on a research collaboration with Woods Hole Research Center. They're a climate think tank here based in Massachusetts, but they've been working on climate since 1985, have a global reach, and are really a research-led organization, which has made them a great partner for us in this work. And another reason we chose to focus on physical risk is that we've had a lot of great work already being done on transition within Wellington and across the investment community. So we thought that we could contribute to the understanding of the market on this aspect of climate risk. And ultimately, our goal is really to paint a holistic picture of how both transition and physical risk interact and impact the investments that we're making on our clients' behalf. All too often, I think the two are compartmentalized, they're discussed separately, and we really need to bring them together to understand those interrelationships. So, for example, how might the physical impacts of climate change, we've raised them a bit already, the increased frequency of hurricane, drought, wildfire, how will that drive policy to accelerate, to drive the energy transition forward? How could adaptation investments impact the efforts that we have on the transition side to reduce emissions? And I think what's really important to remember too is that the two are not sequential. Unfortunately, it's not that we'll be able to avoid all of the physical impacts if we do the best we can on transition now. That would be great, but the truth is that we'll at best be able to bend the curve, which we need to do, but we won't be able to avoid it altogether, because what we don't talk about enough is that scientific projections have a lot of climate impacts already baked in. All of four of the RCP scenarios that scientists use to do the scenario analysis are really, they have the same pathway for emissions through 2050. It's really after 2050 that the 8.5 RCP scenario shows much worse outcomes. So that means in the next 30 years, that's within most investors' time horizon, we're going to be dealing with both transition and physical risks, regardless of what happens on transition. Consumer preferences, policy. The reality is, companies are going to be dealing with both transition and physical at the same time. So bringing that back to the oil and gas industry, fossil fuel companies, as we all know, have really been ground zero for that transition risk conversation due to the emissions from the use of their products. But we think physical risk is going to have a meaningful impact on infrastructure, operations, future estimates for demand as well. So I can bring this to life with a bit of data from our work on Houston, actually, in the Gulf region, where a lot of infrastructure for the industry is concentrated. So when we look at the 1980s, 1990s, where a lot of the infrastructure was built, at that time there was about a 1% probability of the region experiencing 400 millimeters of rain due to hurricane events each year. In the 2030s and 40s, around the corner, that is going to go up to 580 millimeters of rain. So that's more than a 40% increase in the rain that is expected from hurricane events. And if we look at other variables like wind, for example, wind intensity, we see that same trend. So one thing that we focused on as an outgrowth of that work has been to help companies assess those risks, disclose them to investors. Our climate research team, in collaboration with one of our partners on the initiative, CalPERS, we put together a guidance document called the Physical Risk of Climate Change, PROC for short. And within that, we've come up with another acronym, DELTA, to really provide a framework for companies to analyze and disclose this. So DELTA stands for demand, expenditures, logistics, talent, and acquisition. So to quickly go through what that could look like for an energy company: demand. How could the sources of future oil demand change? So India is often cited by many companies as a key source of long-term fossil fuel demand, and yet they are one of the most vulnerable to the physical impacts of climate change. Expenditures. How are companies factoring in resilience expenses into their CapEx plans? Logistics. How could the company's supply chains be impacted? What are contingency plans around that? Talent. Many energy companies operate in high physical impact risk areas. So how could that impact the health and safety of their employees? And finally, acquisition. What are companies factoring in when they're making acquisition and expansion plans? So we've brought that framework into our discussions and engagements with companies, and I think it's been useful because we don't have a lot of standardization yet in that kind of disclosure. And I think the leading companies really see the benefits of doing this work, that they are able to assure their investors that they are on it, they're managing that risk, and at the end of the day, they'll realize a competitive advantage from that.
Mm-hmm. That's wonderful. Thanks. And yeah, I'll ask you another question. I mean, as an asset manager, you get to have sort of an informal poll of what asset owners are interested in because they come tell you, right? And I'm curious what they have. What have you been hearing over the last 6 months from asset owners in terms of what they're interested in terms of their portfolios? Have you seen any change from the onset of COVID-19? Has that impacted that 6-month trend? And then the last thing is, when they come to you, what level of sort of granularity or do they have? Are their perspectives on the oil and gas sector specifically? Do they say, I want out of the sector? Do they say which companies are transforming? What are the kind of questions and thoughts that they have?
Sure. So I think the biggest shift, and it surprised even those of us close to it, the biggest shift we've seen is the interest in decarbonizing portfolios. So investors like never before are focused on the emissions of the companies in their investments. And here we're seeing markets move much faster than policymakers. So even without a strong policy response to align with Paris and much of the world, it really doesn't matter. We're still seeing that growing trend of investors maybe jumping in and wanting to act on their own through that decarbonization objective. So what we've seen with companies in our conversations is that that's really led to a realization that the company's carbon emissions is becoming key to their investability. And companies are thinking about how it's going to impact their cost of capital. So we're talking about asset managers like Wellington, asset owners, our clients, but with banks, we can look at how the banks are increasingly going to understand these risks and price them differently. So I think that's really been, we're having a lot more conversations with our clients, and I think that it's set to continue. And the current crisis, in my mind, especially given all the parallels that Jeremy highlighted at the beginning between COVID and climate, I think will only intensify that interest.
Mm-hmm. Okay, great. Thank you for that, Carolina. So maybe, Anna, I can turn to you. So you have you get the privileged position of getting to speak to investors, to companies, ask the tough questions, your role as a journalist. And I'd be interested, given that sort of go-between role, how do you see the current dialogue? And we know there's a lot of this in the shareholder resolutions that Andrew mentioned earlier, and in informal dialogues. There is a dialogue going on between investors and companies as to what they should be doing in light of climate-related risks. I suspect, strategic decisions about harvest or diversification, and maybe not in those terms, but would come up. But how do you see that dialogue happening today? And where do you think the disconnects are? Places where investors are asking for one thing, but companies are giving something else, or vice versa.
Sure, yeah. So there's definitely a lot of dialogue on this topic, and it's growing tremendously quarter on quarter. In general, it still seems that there's not really a clear consensus on what people are after, what are the key data points to watch. So, for instance, there seems to be a growing consensus within the oil and gas industry, within the investment community, that sustainability is going to be a key component going forward and a growing area of concern amongst especially investment assets. But how exactly you measure it and how you compare companies to each other or to their own work, that's where there's still a lot of uncertainty. And you even see it with regard to the amount of frameworks or types of reporting that are available, right? If you look through the types of sustainability frameworks different companies disclose, you've got things like CDP and GRI and SASB and TCFD, and they're all sort of measuring different things, have slightly different criteria for being included. That makes it hard on a company perspective to figure out what data to provide, and makes it hard on a shareholder perspective to figure out which data points to follow. At Bloomberg, we try and track a lot of company data to make it easy to assess all companies in comparison. And even on this sense, there's a lot of different data points that we try and provide to investors. It's everything from what kind of data are companies disclosing within their ESG reporting. As Carolina mentioned, we have mapping tools where you can kind of try and see assets, see where they fall with regard to different layers of climate or weather, things like that. We have data on investors, who's investing in the company, who holds their debt, what's their portfolio look like, how has their portfolio changed over time, so you can try and see piece out what they're looking for. But in general, a lot of the requests that we're getting are that there's a lot of desire for more concrete data that's quantitative. There's a lot of times people want something that they could throw into their own risk models and add it as an additional data point to explain more risk. And also, how do you verify these data points, right? You have some companies aiming, you talked about the sort of transition versus, continue with current business or pivot, right? How do you measure emissions if there's very different companies? So there's a lot of sort of segmentation also trying to be figured out.
Yeah, absolutely. That's very interesting. And what I think is also particularly interesting about it is you've talked about the need for some kind of essentially of uniformity, so people understand what they're getting, something that can be an input to what investors are modeling, right? And then some ability to verify that. And so those are, a lot of that are traditional roles of capital markets disclosure requirements, assurance protocols around accounting standards. So we all know, everyone's accounting to GAAP or whatever it is, rather than using their own particular metric. I'd be curious, do you think that is, is that a clear need here in this area to have standardization along those lines, something that was, at the very least alluded to, and if not explicitly referenced in the Financial Stability Board's Task Force on Climate-Related Financial Disclosure?
Exactly. I think that pretty much hits the nail on the head. We anticipate at Bloomberg that there is going to be sort of a move towards a general organization with regard to sustainability, some type of key metrics that sort of everyone is looking towards. There's a lot of people trying to build those, right? All the different frameworks, as I mentioned. We at Bloomberg are trying to build our own, at least, portfolio of metrics to follow. There's a few trends that we see are seen as valuable and therefore will likely be what drive the industry. So one of those is quantitative. The more quantitative a metric can be, the better, because then it can be compared to over time. It can be compared across firms. It can be added into different risk weighting calculations I mentioned before. So quantitative metrics such as emissions intensities or carbon, total emissions, anything along those lines is better than sort of a qualitative approach. Another piece we see is it will likely become more rigorous and more specific. And what I mean by that is you mentioned, how do you verify these? How do you hold it accountable, right? So we've even seen that trend approached by a few companies. For instance, BP, when they were looking at pipeline emissions, at first they were using sort of general industry standards around emissions factors of the infrastructure they're using. They've since, I think through pressure on them, responded that they're actually installing their own sensors to actually measure it. So that's like a more verifiable and therefore more valuable metric than the former. We also think it'll become a bit more industry specific. So I think we've alluded to this on the panel, but how do you compare the emissions of, say, Neste that's using biofuels with, or even like an integrated major, like an Exxon versus a small E&P operator, right? The Exxon's emissions will be greater because they have a refining arm, they have an upstream arm. It's comparing apples to oranges in that regard. Similarly, with regard to the slate of products being produced, right? If you're a company producing mostly natural gas, the emissions around that and what it's displacing and everything are going to be different than if you're a company producing heavier fuels. So those are, and because of those considerations, we think a lot of these metrics will become a bit more specific, and so that you can compare segments of businesses, you can compare business to itself to see how they're doing with regard to their own goals. Those are the kind of useful metrics that we see developing throughout the industry. And lastly, you mentioned sort of gap in accounting. That's kind of where we see it trending towards. That would be the ultimate goal, I think, for sustainability, so that it is something that is understood more broadly and very quickly.
That's great, really. Thank you very much for that. So by the way, I've seen a number of great questions coming through on the questions tab. So please keep those coming. I'll get to those shortly. I just had a couple of other questions I wanted to ask. And coming back to this diversification or harvest strategy, one observation I would make is that virtually every company that is setting climate targets in the industry today is focused on the diversification approach, right? And to varying degrees. I mean, there are emissions reductions targets, but then you can look at what the capital investment profile is, how much of the total capital investment is going into renewables, and there's a fair variation there. But ultimately, strategically, the messaging is all about diversifying. And I sort of question, starting with Jeremy on this. So, just from management's perspective, not yours in particular, but for the industry facing this kind of an issue, is there something about a harvest strategy, i.e. winding down the business, that is sociologically, psychologically, or for whatever other reason, too difficult to implement? Is it bad for employee morale? I don't know. Is it a dismal outlook? Is it that harvest is the only way that companies can go? What do you think?
Well, that's a very good question, and obviously Neste does face that question also. I mean, we do have conventional oil refineries. We do have retail sites that sell gasoline and diesel today. So how do you make sure that those employees are motivated when a lot of the discussion is about renewables? But the fact of the matter is that we need liquid fuels today. There are millions of vehicles driving on the roads today. There are thousands of planes in the sky today that will be there for decades to come. And so there is a need for those fuels. It's a question of how do you transition them? How do you make those fuels better? And one of the things that Neste is looking at, for example, is how do we use a conventional oil refinery to, rather than processing crude oil, how can it process a renewable feedstock? Yeah, so there we're committing to getting to 1 million tons per year of renewable feedstock going into a conventional refinery. So those are transformations that everybody can get behind. If you're on the fossil refining side, you can look forward to, hey, how do we make this happen? And then you have on the other side where Neste is the world's largest producer of renewable diesel, but we are looking beyond that. We're also looking at sustainable aviation fuel Today, we have the capability of producing 34 million gallons per year, but with our Singapore expansion, which is going to come online in 2022, we'll make a tenfold increase in that. We'll be able to get to 340 million gallons of sustainable aviation fuel. And that's a drop-in solution. But then we're also thinking, okay, what else is there out there? And we've got a whole team looking into renewable polymers and chemicals. How can we either use renewable feedstocks to get into the plastic chain, or how do we reuse recycled plastics? Can you convert them back into plastics? What else can you do in that space? So we've got these, if you want, these different layers within the company, but it's all going in the direction of renewables. Whether it's on the fossil fuel side or whether it's the future, it's all in renewables. It's all in reusing carbon again and again and again.
That last point's very interesting on the scenario on the plastics. If for no other reason, when you look at a lot of what companies are projecting in terms of demand for their products going forward, and I mean the conventional super oil majors, it does involve petroleum products and plastics and other things. But if people are using recycled plastics materials, I think that's an interesting challenge there. Yeah, so Caroline, do you have any? You mentioned that investors have been interested in decarbonizing at the portfolio level. And what I'm curious about is there a clear translation, and I'm not sure that there is, but is there a clear translation as to what the strategic recommendation is for an individual oil and gas company if an investor is going to be saying, I want zero carbon in my portfolio by 2050 or whatever year it is?
So as the oil and gas analyst on our ESG research team, a key part of my assessment framework is understanding how companies are assessing climate and taking that to inform their long-term strategy. So to answer your question, I don't think there is a one-size-fits-all recommendation. I think it really will be different because companies will have different skills, different assets, different risks, different opportunities. And I also think that there isn't necessarily a trade-off between the short-term shareholder return versus the long-term sustainability. This is a transition. After all, I think Jeremy's brought that to life in his description as well. The global energy system will not change overnight, but those companies that can really skillfully manage the transition, drive shareholder returns now, and develop that long-term strategy to adapt, I think that's what investors are really expecting of them. As one energy company CEO told us recently, they're looking to deliver in the next quarter, the next year, the next 10, and the next 50. And when I look at the companies that I work on, ultimately what I found is that the ESG outperformers have three things in common. They have strong risk management practices, they have long-term strategic thinking, and they have adaptability. They're able to evolve with changing market conditions. And I think that ultimately we're looking for those companies that have those characteristics, because those will be the ones that will deliver returns for our clients throughout the transition.
That's great. I really appreciate that. Thanks. So interesting. So look, I think just in the interest of time, if we could turn quickly to some of the questions that we've been asked. So we've got a number here, and I will pick through these and get to as many of them as I can. So, but any of the panelists, feel free, if you have a view on one of these, feel free to jump in. So one question I think is interesting is whether that's been asked is whether oil and gas companies can lead decarbonization of the energy system, or is it simply a reaction to evolving demand? So I guess there's really kind of two parts of this. What should they be doing, and what in fact are companies doing? And you can answer either or both if anybody has a thought on that.
Well, if I may, Rob, I mean, one thing that strikes me is a bit of a contradiction that oil and gas companies can lead decarbonization when actually they are in the business of producing fossil fuels. So it's rather, how can oil and gas companies transition to reusing carbon? So that's just something that struck me, and I think it was a great question. But there's one thing that I might like to comment on Carolina's last comments. We seem to there is no one solution to climate change. And I think for investors, it's also confusing because you can't substitute oil and gas with one other thing. There's so many other choices out there. And at the moment, electrification seems to be quite sexy. Everyone's talking about it, but it's not necessarily a today's solution for everything. Yeah, I would generally believe we're going to go to a polyfuel world where there are going to be solutions for different market areas. There's going to be solutions perhaps for shipping or for private transportation or for aviation. Or for cement manufacturing, but there's not going to be one single solution, and that's why trying to navigate how are these different sectors going to evolve is going to be quite interesting.
Sure, that's a great point, and that's why, yeah, that's right. There's not going to be everyone picking the same approach, and whether that approach is right for a company is going to maybe come down to the specifics and the adaptability, as Carolina pointed out. That's great. I have another question that's come through relates to the various disclosure frameworks, and the question is how do these get unified? I mean, how does someone make sense of this, or are we just going to be dealing with apples and oranges to the end?
I mean, I could hop in here. This is something we track quite closely. So at Bloomberg and BNF, we've really been putting in an effort to try and explain what exactly all of these frameworks are, who's available to report, and then provide that data that's clear as to who's reporting what, and what are the numbers that they show. So make it as, try and drill down into the components as much as possible, because those are ultimately the pieces that are, I think, of most interest usually to stakeholders is, where can you find the actual data points that are, all of these frameworks are basically trying to measure different aspects of the same thing. So as much unification as you can get on them. And some have strengths, they have all different strengths and weaknesses. So actually some are better for different industries than for others. I think science-based targets is one that's getting a lot of attention. They don't yet have a framework for oil and gas. So that's one where you can kind of see that it doesn't always, you can't always just have a simple way of measuring all of this. And it does go back to, I think, the question on how do companies respond, right? Even if you look at this question of transitioning, you might have Neste that's putting a lot of interest in renewable fuels, renewable liquid fuels. Then you have a company like Total that's maybe moving into a utility space. Then you have a company like, Occidental, which is sticking with its core oil and gas business, but trying to make it zero emissions by doing CCUS and building that up, right? All of those are very different strategies. And so trying to even compare those three companies in terms of their emissions, right, is tricky. Then it goes back to what Carolina was talking about, which is what are the components that you can use to try and figure out how they're doing against their own benchmarks, how they're doing, thinking about this space in a broader term of different risks and long-term transition.
I would just
go ahead, Carolina.
I would just add that it is a true challenge from the investor perspective to try to normalize across all of this information. So it's a real problem for us to understand what's really going on. And I wonder if the regulation that's coming out of Europe, the first standard setters are going to really dominate. They're going to set the standard globally. And Europe seems to be really on that track. So it may happen for us in the near term.
And I was just going to say that that Anna was perfectly encapsulating the fact that this is going to become many different solutions, and how do you measure them up against each other? And the only thing that we see is that companies are sometimes trying to hide behind picking a solution that doesn't quite exist yet. And there should be, you can't wait for the perfect solution to come. There are concrete things that companies, that cities, that governments can do today. If there's the right policy framework, and that goes to Carolina's point of the EU setting already some things in place. There's a great opportunity for having the right policy, having smart policy to drive this transformation as well.
That's super. Listen, let me. Here's another question that I'm not sure who this goes best to, but I'll let you guys pick. There is a question of really looking at the investable oil and gas space today. Are we seeing concerns about climate translated into increased costs of capital for companies that are not decarbonizing fast enough. I don't know if who's best placed for that, but does anybody have some thoughts on that?
Maybe I'll just say that it's hard to quantify and isolate specifically, but it's hard to imagine it's not part of the negative sentiment. And one thing we can quantify is the increased divestment news that we're seeing. So it's not wide scale really yet, but there is a steady beat of asset owners deciding that this is going to be their way to make a contribution on the climate issue. So it's hard to imagine that it's not impacting.
Right.
But I think also on the customer side, the end customer side, you've also got those companies that want to be the green swan companies, that also want to lead this change and that also choose to become more sustainable. So I think it's those companies that are in oil and gas that are transforming, but it's also on the other side, it's the customers that are choosing to transform their business. So they will pair up at some stage.
Mm-hmm. Mm-hmm.
I'd add one last thing. If you kind of flip it on its head a bit, one of the things that we track at BNF is sustainable finance. And so we have, one of my colleagues is the expert over there, but they have been doing a lot of look at how is sustainable finance being impacted by COVID and the transitions here, what's going on in the industry. There are a number of obviously new relief funds around healthcare and education. There's still a decent amount of investment in clean energies. There's also a lot of new, even on a broader, longer term basis, a lot of new bonds being developed to try and incentivize the industry, right? So this is like, not necessarily is their capital facing different rates, but is there more capital going towards cleaner stuff? For a while, green bonds, right? That was kind of the start, where it's if a company is investing in something explicitly renewable, like a wind project or EVs for their operations, they could get a green bond. There's a new category developing that's, I think, called sustainability linked bonds, right? So this is, maybe it's not for green itself, but if you have a company that's trying to improve their operations and move to be more sustainable, they can maybe issue some of these. It's still a relatively new category, and I don't think there's been many applications in oil and gas, a few, but not many. But that would be a metric that we're watching quite closely to see if there is going to be a tangible change in how sort of access to capital is evolving with this sustainability push.
Mm-hmm. Great, that's great. Well, we're about to wrap up, but I would just like to get a final thought from each of you before I pass this back to Andrew. What's next for oil and gas? I think we've talked that there's going to be a multitude of strategies, but what's a final thought you'd like to leave the audience with? Why don't we start with you, Anna?
Sure. So I think the biggest for me is there's going to be a lot more data coming out, and really watch who's reporting and what they're reporting. That's probably one of the best metrics at the moment, is look at a company, see what data they're putting out, how it compares to their peers, how much detail there is within it. That's going to be kind of the key benchmarks at the moment in order to try and evolve this space.
Mm-hmm. How about you, Carolina?
So I'd say, and it's been highlighted in the COVID crisis, I'd say that we're really likely to see the differentiation in long-term strategy accelerate. And companies are going to take different paths. Not, there's no one option here, but there's going to be increased movement. And I think that's behind, we've really seen some of the European majors double down on their new energies commitments in this environment. And I think that's a first sign of more to come.
Mm-hmm. Great. Jeremy?
I think from my thoughts would be along the question that we had earlier about feedstocks, is how do we find more feedstocks to be able to enable this transition? So waste and residues, increasing the availability of that, looking at new ways of producing renewable feedstocks. I think that for Neste, that's going to be an exciting growth, while at the same time we produce more renewable fuels so that our customers can reduce their emissions even further. So it's working on both ends, on the feedstock side and then supporting our customers. I think that's going to be the big thing for Neste over the next couple of decades.
Great. Well, look, I'd like to thank all the panelists for what I thought was an excellent discussion. I really appreciate all the thinking you've put into this. And Andrew, I'd like to turn it back to you.
Great, thank you, Rob, for the excellent moderating, and thanks to all of our panelists for what I certainly found to be a really interesting and useful discussion. I just wish it could be a bit longer, but we are at the top of the hour. Before we adjourn, I do want to just take a second to thank all of our sponsors that you see on the screen, who have really helped us make this transition to a virtual conference this year. As I said at the outset, you will be receiving a follow-up email, hopefully later on today, that provides a link to the recording of this session, so you can go back and re-listen to any and all of it. And then for those of you who are part of the broader Ceres 2020, our next session is going to be Tuesday, May 19th, Accelerating Clean Energy in Supply Chain. So next Tuesday at 11 Eastern, and you can learn more about that at our website at ceres2020.org. And with that, we'll wrap and let everyone go back to their days. Take care.
Thank you.